What if I told you that real estate has quietly created more millionaires than stocks, crypto, or even winning the lottery? That's right, behind the scenes of every city skyline, every apartment building, and every neighborhood lies one of the most reliable paths to lasting wealth. Yet most people never take advantage of it because they believe the myths. I don't have enough money, I don't have enough knowledge, it's too risky. That's where Ken McElroy steps in. As a seasoned investor, property manager, and longtime advisor to Robert Kiyosaki, the author of Rich Dad, Poor Dad, Ken has spent decades not only investing in real estate, but also teaching thousands how to do it successfully. In his book, The ABCs of Real Estate Investing, he strips away the confusion, the jargon, and the fear, breaking down the entire process into simple, actionable steps. And that's exactly what this audiobook summary will deliver to you. Over the course of this breakdown, you'll learn why real estate is the ultimate wealth-building machine, the difference between buying a home and buying an investment, how to evaluate deals using real numbers, not emotions, the secrets to finding, financing, and managing properties, and most importantly, how to build a team and a system that allows your portfolio to grow while you focus on creating the life you truly want. This isn't theory. These are field-tested principles from an investor who has done hundreds of deals, managed billions in real estate assets, and built financial freedom through property. So sit back, listen closely, and take notes, because by the end of this summary, you'll understand the ABCs of real estate investing and how you too can step onto the path toward financial independence. Part 1. The Power of Real Estate. Imagine waking up in the morning and realizing that while you were asleep, your money was hard at work. Rent was being collected, mortgages were quietly reduced by tenants, and your equity was growing even though you hadn't lifted a finger. This is the hidden strength of real estate. Unlike many other investments, real estate doesn't wait for you to act. It works around the clock, producing income, building wealth, and providing leverage opportunities that can accelerate your financial freedom. Ken McElroy begins his book by reminding us of a powerful truth. Real estate has been one of the most reliable wealth-building tools in history. While the stock market can rise and fall with investor emotions and businesses can collapse overnight, real estate stands on a more stable foundation because it fulfills basic human needs. People will always require a place to live, to work, and to gather. That simple fact makes real estate practical, resilient, and profitable. The reason real estate has created more millionaires than nearly any other investment class is that it generates returns in multiple ways simultaneously. Each property you own can produce steady monthly cash flow through rent while also increasing in value over the years. At the same time, tenants are the ones paying down the loan, which gradually builds your equity without you having to touch it. Additionally, the government often rewards property owners with tax breaks, depreciation benefits, and other incentives that mitigate the tax burden. And then there is leverage, the unique ability to control a large asset with only a fraction of the purchase price. With a relatively small down payment, you can own property worth several times your investment, which magnifies your returns far beyond what is possible in most other investments. This is where the mindset shift comes in. Most people spend their entire lives trading time for money, working long hours in the hope of a promotion or a raise. Yet their income remains limited because it depends on their physical presence. Real estate, on the other hand, allows money to work for you. Once you acquire income-producing property, each building or unit becomes like a silent employee that never stops. Month after month, it generates income, pays expenses, and builds wealth for you regardless of whether you are actively working. This is the true difference between financial struggle and financial independence. Still, many people hesitate because of the myths surrounding real estate. They believe they need a fortune to get started, but McElroy shows that many investors begin small, using creative financing, partnerships, or modest properties. Others worry that real estate is too risky, but the truth is that risk exists in every investment. With proper knowledge and due diligence, the risks in real estate can be reduced to manageable levels. Another common excuse is lack of time, yet the entire point of real estate is to eventually buy back your time. Yes, effort is required in the beginning to learn the process, analyze numbers, and set up good management. But once the systems are in place, the reward is time freedom. Compared to other investments, real estate stands out for its balance of stability and control. Stocks may produce high returns, but they're volatile and influenced by forces beyond your control. Bonds and savings accounts are safe, but they hardly beat inflation. Businesses can be rewarding, but they demand constant involvement and carry high risk. Real estate sits in a unique position. It is tangible, stable, and under your influence. You can increase its value by improving the property, raising rents, reducing expenses, or managing it more efficiently. Few other investments give you that level of control. One of the most powerful features of real estate is leverage. With stocks, you can only buy as much as your money allows. But with property, banks are willing to finance most of the purchase price because the asset is solid and backed by collateral. This means that with $50,000, you might purchase a $250,000 property. If that property rises in value by just 5% in a year, that is $12,500 gained, not on your $50,000 alone, but on the entire property value. That kind of return is only possible because of leverage. Add cash flow and tax benefits, and the wealth-building effect becomes exponential. The real key, however, is the long-term perspective. McElroy warns against chasing quick wins or speculation. Real estate is not about getting rich overnight. It is about building sustainable wealth that lasts for decades. Think of it like planting a tree. At first, the progress is slow and almost invisible. But with time, the roots take hold, the trunk grows stronger, and eventually the tree provides shade and fruit year after year. Real estate investments follow the same pattern. The first property may feel small, but over time, with patience and consistency, it grows into a portfolio that provides income, security, and freedom. The most inspiring part is that real estate success is not reserved for the wealthy or the highly educated. McElroy shares stories of ordinary people, a teacher, a nurse, a small business owner, who started with little more than determination and a willingness to learn. They purchased their first property, often modest and unremarkable, and over the years built real wealth. Their results came not from luck or privilege, but from taking action and staying committed. This is the power of real estate. It is not mysterious or reserved for a select few. It is a proven path available to anyone who is willing to learn its principles, challenge old beliefs, and take consistent steps forward. With each property you acquire, you are not only buying bricks and mortar, you are buying streams of income, tax benefits, equity growth, and leverage that will compound over time. McElroy's first lesson is clear. Real estate is not just another option on the list of investments. It is a powerful, dependable vehicle that has the potential to free you from the cycle of working for money. It can give you control over your financial future and create a legacy that lasts long after you are gone. Once you recognize this truth, you begin to see that the path to financial independence is not hidden. It is right in front of you, waiting for you to take the first step.
Part 2. Understanding the basics. Once the power of real estate is clear, the next step is understanding the basics. Many beginners approach property with the mindset of a home buyer, not an investor, and that is where mistakes begin. Buying an investment property is not about emotions or personal preferences. It is about the numbers. Real estate investing is, at its core, a numbers game. If the numbers work, the deal works. If they don't, no amount of charm or curb appeal can make it profitable. Ken McElroy emphasizes that the first and most important principle of real estate is cash flow. Too many people are seduced by appreciation, the idea that a property will rise in value and they will sell it later for a big profit. While appreciation is real, it is also unpredictable and largely outside your control. Cash flow, on the other hand, is measurable and immediate. It is the money left over each month after you collect rent and pay expenses, and it is what allows an investor to sustain ownership long enough for appreciation to work in their favor. A property that produces steady, positive cash flow is like a machine that funds itself month after month, while also building long-term wealth in the background. To calculate cash flow, you must understand the basic components of income and expenses. Income comes from the rents and any additional revenue streams, such as parking fees, laundry machines, or storage units. Expenses include property taxes, insurance, utilities, maintenance, repairs, management fees, and mortgage payments. What remains after subtracting expenses from income is the net operating income, commonly referred to as NOI. From there, you deduct financing costs to arrive at your actual cash flow. This is the heart of investment analysis. Once you learn to look at real estate through this lens, you start to see opportunities differently. A beautiful house in a great neighborhood may not be a good investment if the rent cannot cover the expenses. Conversely, a less attractive building in an average area could be a strong investment if the numbers produce solid returns. The lesson is simple. Investors buy income, not appearances. Another key concept is the cap rate, or capitalization rate. It measures the relationship between a property's net operating income and its price. For example, if a property generates $50,000 in NOI and costs $500,000, its cap rate is 10%. The cap rate gives investors a quick way to compare deals and markets. A higher cap rate generally means better returns, though it can also signal higher risk. Learning to evaluate cap rates allows investors to make informed decisions instead of relying on guesswork. Understanding the basics also means grasping the difference between single-family and multifamily properties. Many beginners start with single-family homes because they feel familiar and manageable. However, multifamily properties often provide stronger cash flow and reduced risk. With a single-family home, if your tenant leaves, your income drops to zero until a new tenant is found. In a building with 10 units, one vacancy still leaves you with 9 streams of income. This diversification makes multifamily investing particularly attractive, and McElroy encourages investors to consider it early. He also stresses the importance of due diligence. Numbers on paper may look attractive, but a wise investor digs deeper. Are the rents realistic compared to the local market? Are expenses accurately reported, or have they been underestimated to make the deal look better? Are there hidden costs, like deferred maintenance or upcoming property tax increases, that could erode returns? Successful investors develop the discipline to investigate thoroughly before committing. They do not fall in love with a property. They fall in love with the numbers. McElroy also draws attention to the distinction between being an owner and being an investor. Homeowners often make decisions based on personal taste, what color the walls should be, how the kitchen looks, or whether the yard is big enough for children. Investors must remove emotion from the process entirely. A property is not a reflection of your personality. It is a business. The question is not, would I like to live here? But will this property generate strong, reliable income? This shift in perspective is critical. Many people fail because they buy properties that appeal to them emotionally, but fail to perform financially. The basics of investing remind us that profitability always comes first. Even if the building isn't perfect, if the numbers work, it is a good deal. And even if the property looks flawless, if the numbers don't work, it is a trap. Another foundational principle is understanding how small changes in management can dramatically affect returns. For example, raising rents modestly, in line with the market, can increase income significantly over time. Reducing unnecessary expenses or negotiating better service contracts can also boost profitability. Because real estate values are tied to income, even small improvements in NOI can increase the property's overall value substantially. This means that investors are not passive recipients of market forces. They can actively shape the performance of their investments. McElroy explains that real estate should be evaluated not just as a purchase, but as a system. A property is a business with revenue, expenses, and profit margins. When you adopt this mindset, you begin to see how each decision, whether it is tenant selection, maintenance strategy, or financing, affects the bottom line. By mastering these basics, you gain control over your outcomes and protect yourself from costly mistakes. One of the greatest liberating aspects of understanding the basics is realizing that success does not depend on luck or timing. It depends on applying proven principles consistently. Cash flow analysis, NOI, cap rates, due diligence, and management practices are tools that anyone can learn. Once you know them, you can walk into any market, look at any deal, and evaluate it objectively. This knowledge turns fear into confidence and speculation into strategy. At its core, Part 2 of McElroy's book is about shifting from a consumer mindset to an investor mindset. Consumers buy with their hearts. Investors buy with their heads. Consumers think about how a property feels. Investors think about how it performs. Consumers hope for appreciation. Investors build for cash flow. Making this transition is the foundation of every successful real estate journey. By the time you absorb these basics, you begin to see why so many people fail at real estate. They confuse owning property with investing in property. True investing is about building wealth systematically, not gambling on rising prices or buying what looks good. Once you commit to focusing on cash flow, understanding the numbers, and treating every property like a business, you step firmly onto the path of financial independence.
Part 3. Finding and analyzing deals. Once the fundamentals of real estate investing are understood, the natural question becomes, where do you actually find good deals? Many new investors assume that great properties are obvious and advertised widely, but the truth is quite different. The best opportunities are rarely sitting on the front page of a listing website. Instead, they are found through networks, persistence, and the ability to see value where others overlook it. Ken McElroy emphasizes that deal flow is the lifeblood of investing. The more deals you see, the better your chances of finding the right one. This is why successful investors are constantly scanning their markets, talking with brokers, networking with other investors, and building relationships with property managers and lenders. Each of these contacts can become a source of leads. While a casual investor may look at a handful of properties once in a while, serious investors review dozens, sometimes hundreds, before choosing the one that meets their standards. But seeing many deals is not enough. You must also learn to analyze them quickly and accurately. That means knowing which numbers matter and which are distractions. McElroy advises starting with the property's income and expenses. The asking price is irrelevant until you know what the property produces. Does the rent roll match the market, or are tenants paying less than they should? Are there vacancies? And if so, are they temporary or a sign of weak demand? What about expenses? Are they inflated, or could they be streamlined? These questions form the backbone of analysis. Another point he stresses is that the first numbers you're given are often unreliable. Sellers and brokers naturally want to present the property in the best possible light. They may understate expenses or assume overly optimistic rental income. This is why due diligence is so important. You must verify everything, from utility bills and tax records to maintenance logs and tenant leases. An inexperienced investor may take the numbers at face value, but a seasoned investor digs until the true performance of the property is revealed. A good investor also learns to look beyond the present and see the potential. A property may not look attractive at first glance. It may be poorly managed, under-rented, or cosmetically outdated. Yet those very weaknesses can become opportunities if they can be corrected at a reasonable cost. For example, if a building's rents are far below market, simply adjusting them over time could increase income significantly. If expenses are bloated due to poor management, better oversight could restore profitability. If the exterior looks run down, a modest investment in repairs and upgrades could make the property far more appealing to tenants. This ability to see what a property could be, not just what it is, often separates successful investors from those who pass by great opportunities. McElroy also notes the importance of market analysis. A good property in a weak market may still struggle, while an average property in a strong, growing market can thrive. Investors must pay attention to local economic indicators, job growth, population trends, business activity, and infrastructure development. A neighborhood on the rise, with new employers moving in and demand for housing increasing, can make a property much more valuable over time. Conversely, an area with shrinking employment and declining population may drain even the most well-managed building. This is why many investors develop a strategy of specialization. Instead of trying to chase deals everywhere, they focus on a specific market or property type and learn it deeply.
This expertise allows them to recognize opportunities faster and act with confidence. McElroy himself emphasizes the value of being a specialist, because the more you know your chosen market, the less likely you are to be fooled by surface impressions or inflated claims. Finding deals also requires creativity. Not every opportunity comes through traditional channels like the multiple listing service. Some of the best properties are never advertised at all. They may be sold quietly between investors, passed on through word of mouth, or offered directly by owners who prefer not to list them publicly. This is why building relationships with brokers, lenders, and property managers is so powerful. They often hear about deals before they reach the wider market. In some cases, you may even approach property owners directly, expressing interest in buying if they are ever ready to sell. Over time, these efforts create a steady flow of potential opportunities. When analyzing a deal, the numbers must always come first, but McElroy reminds readers to also evaluate the story behind those numbers. Why is the property being sold? Is the owner retiring, struggling with management, or simply cashing out? What is the history of the building? Has it been well maintained, or has it suffered from years of neglect? Numbers can reveal a lot, but the human context often explains why an opportunity exists in the first place. Financing is another critical piece of analysis. A deal that looks good on paper may fall apart if financing terms are unfavorable. Interest rates, loan-to-value ratios, and amortization schedules all affect cash flow. This is why experienced investors build strong relationships with lenders and understand what financing structures will best support their strategy. In some cases, creative financing can even make a deal possible when traditional lending would not. McElroy is clear that finding and analyzing deals is not about luck. It is about systems. The investor who has a routine of reviewing listings daily, calling brokers weekly, networking with industry contacts, and running the numbers consistently will always find more opportunities than the person who waits passively for a perfect property to appear. The disciplined investor builds pipelines, tracks leads, and refines their analysis over time. One of the greatest lessons in this part of the book is that opportunities are abundant for those who know how to look. The market is full of properties with potential, but only those who master the skill of analysis can separate the gems from the traps. By committing to see many deals, dig deeply into the numbers, evaluate markets intelligently, and cultivate relationships that reveal hidden opportunities, investors position themselves to consistently acquire properties that build wealth. This part of the journey can feel overwhelming at first. So many numbers, so much uncertainty. Yet, with practice, it becomes second nature. The more deals you analyze, the more patterns you begin to see. You start to recognize what a strong property looks like almost instantly. Instead of guessing, you know. Instead of hoping, you calculate. This confidence not only protects you from bad deals, but also allows you to act decisively when the right one appears. By the end of this stage, the aspiring investor understands the challenge is not whether deals exist. They are everywhere. The challenge is whether you have trained yourself to find them, analyze them, and seize them before someone else does. With this mindset, you are no longer at the mercy of chance. You have a process, a system, and the ability to turn potential opportunities into real investments. Part 4. Financing and Leveraging. At this stage of the journey, after finding and analyzing deals, the next crucial step is answering the question every investor faces: how do you pay for it? Many people allow the fear of financing to stop them before they even begin. They assume you need to be wealthy already or that banks only lend to the privileged few. Ken McElroy dismantles these myths by explaining that financing is not about having a pile of cash. It is about understanding leverage and using it wisely. Leverage is one of the most powerful forces in real estate investing. Simply put, leverage means using borrowed money to control an asset that is far larger than the cash you personally put in. For example, with a down payment of $50,000, you could buy a property worth $250,000 if a bank finances the rest. That $50,000 is now controlling a $250,000 asset. If that property generates steady cash flow and appreciates over time, your return on investment can be many times greater than if you had simply parked your money in savings or stocks. This is why real estate is so attractive. It allows ordinary investors to scale far beyond their personal savings. But leverage is a double-edged sword. Used recklessly, it can magnify losses just as easily as it multiplies gains. Borrowing too much or agreeing to terms that strain cash flow can trap an investor in a cycle of stress and risk. McElroy emphasizes that responsible financing begins with ensuring that the property itself generates enough income to comfortably cover the debt. In other words, the deal must make sense on its own before financing is applied. The rent should pay the mortgage, cover expenses, and still leave a margin for profit. If it doesn't, no clever loan structure will save it. Traditional financing typically comes from banks or credit unions. These institutions want to minimize risk, so they examine both the property and the borrower carefully. They look at the property's income and expenses, but they also consider the borrower's credit history, income, and existing debt. For beginners, this can feel intimidating, but banks are not looking for perfection. They are looking for reassurance that the loan will be repaid. This means presenting yourself as a serious, responsible investor and presenting the property as a solid income-producing asset. Beyond traditional financing, there are creative ways to structure deals. Seller financing, for instance, allows the property owner to act as the lender, receiving monthly payments directly instead of a lump sum from a bank. This can be beneficial if the seller wants steady income rather than immediate cash, and it can allow the buyer to acquire property without going through strict bank requirements. Partnerships are another option. By teaming up with someone who has capital, you can bring your knowledge, effort, and management skills to the table while sharing profits. Joint ventures, private money lenders, and even crowdfunding platforms are additional ways investors piece together financing when banks say no. McElroy also underscores the importance of understanding loan terms in detail. Interest rates, amortization schedules, balloon payments, and prepayment penalties all affect the performance of an investment. Two loans with the same interest rate can have drastically different impacts on cash flow depending on how they are structured. For example, a 30-year amortization typically lowers monthly payments compared to a 15-year schedule, but it extends the life of the loan. Some investors may prefer the lower payments to maximize immediate cash flow, while others may choose a shorter term to build equity faster. The right choice depends on your strategy, but the key is to know what you are agreeing to before signing. Another lesson is that financing is not static, it evolves with your portfolio. As you gain experience and build a track record, lenders become more willing to extend credit. What seemed impossible for a first property becomes routine for your fifth or 10th. This is why persistence is vital. The first loan is often the hardest, but each successful deal makes the next one easier. Over time, your reputation, equity, and relationships with lenders become assets in themselves. Investors must also prepare for the unexpected. Vacancies, repairs, or economic downturns can strain cash flow. This is why McElroy advises leaving a financial cushion. Too many beginners stretch themselves so thin that a single setback puts them in crisis. Wise investors build reserves into their financing plan. They assume that some months will be less profitable and that expenses will arise. By planning conservatively, they ensure survival during tough times, which allows them to thrive over the long term. A subtle but crucial point McElroy makes is that financing is not merely about getting money, it is about building relationships. Banks, brokers, and private lenders are people first. They want to work with borrowers they trust. Investors who are transparent, organized, and reliable quickly distinguish themselves. Delivering on promises, meeting deadlines, and communicating openly not only secure the current loan, but also lay the foundation for future opportunities. In many cases, a strong relationship with the lender can give you access to deals and terms that others never see. For new investors, the key is to start where you are. Maybe you can't secure a large loan right away, but perhaps you can begin with a smaller property, partner with someone, or negotiate seller financing. The important thing is to take the first step. Each deal teaches you how financing works, builds your confidence, and expands your options. Over time, you can scale into larger properties with stronger financing structures. Ultimately, financing is not a barrier, but a tool. It is the bridge between where you are now and the portfolio you want to build. When approached with knowledge, discipline, and creativity, financing allows you to control assets far greater than your personal savings would allow. It is how ordinary individuals become large-scale investors. McElroy's message is clear. Do not let fear of financing hold you back. Learn the principles, respect the risks, and use leverage as the powerful wealth-building tool it was meant to be.
Part 5. Building a Team and Systems. One of the greatest misconceptions in real estate investing is the idea that you must do everything yourself. Many beginners believe they have to personally find the property, negotiate the purchase, arrange the financing, manage the tenants, and handle every repair. At first, this may even seem possible with a single property.
But as your portfolio grows, this approach quickly becomes overwhelming. Ken McElroy emphasizes that the most successful investors understand a simple truth. Real estate is a team sport. No one builds $1 million portfolio alone. The most effective investors surround themselves with knowledgeable professionals who fill in the gaps and multiply their efforts. A good team not only saves time, but also reduces risk, improves efficiency, and allows you to scale far beyond what you could achieve alone. McElroy insists that this mindset shift from being a lone operator to being a team leader is one of the defining differences between small-time landlords and serious investors. The team begins with the people who help you acquire properties. A competent real estate broker who specializes in investment properties can be invaluable. Unlike a general agent who focuses on selling homes to families, an investment-minded broker understands cash flow, cap rates, and the numbers that drive deals. They can guide you toward opportunities that fit your strategy, alert you to hidden gems, and even bring you deals before they hit the open market. Building a strong relationship with such a broker often gives you an edge over competitors. Next, a reliable lender is critical. Whether it's a bank loan officer, a mortgage broker, or a private lender, you need someone who understands the financing side of investing. Over time, as you prove yourself capable and trustworthy, lenders become allies who are more willing to work with you creatively. Having this relationship in place can make the difference between closing a great deal quickly and losing it due to delays or hesitation. Property management is another cornerstone of the team. McElroy is particularly passionate about this because he built his career managing thousands of units. He knows firsthand that poor management can destroy even the best investment, while excellent management can turn an average property into a thriving one. A skilled property manager handles tenant screening, rent collection, maintenance, and legal compliance. They ensure that the property runs smoothly day after day. For an investor, this means peace of mind and the freedom to focus on strategy rather than daily headaches. Contractors and maintenance professionals also play a vital role. Every property will eventually need repairs, renovations, or upgrades. Having dependable contractors you trust ensures that work is done properly, on time, and at a fair price. Investors who scramble to find someone each time a problem arises often end up overpaying or settling for poor workmanship. Building long-term relationships with reliable service providers creates stability and efficiency. Legal and accounting professionals are equally important. Real estate transactions involve contracts, leases, taxes, and regulations that can be complex. An attorney who understands real estate law can protect you from costly mistakes and ensure that deals are structured correctly. An accountant who specializes in real estate can help you maximize deductions, track expenses, and plan for long-term tax efficiency. Together, these advisors provide a framework that keeps your investments legally sound and financially optimized. What ties all of these roles together is the investor's ability to lead. Building a team is not about handing off responsibility blindly. It is about assembling the right people and guiding them toward a shared vision. You remain the decision maker, but you rely on the expertise of others to execute effectively. This requires communication, trust, and the willingness to invest in relationships. A great investor treats their team members with respect and fairness, recognizing that loyalty and collaboration are built over time. In addition to people, McElroy emphasizes the importance of systems. Systems are the routines and processes that keep your business running smoothly even when you are not personally involved. For example, having a system for analyzing deals ensures that you evaluate each property consistently based on facts rather than emotions. A system for tenant screening helps you avoid problematic renters. A system for handling repairs ensures that issues are addressed quickly without disrupting cash flow. The beauty of systems is that they create predictability and scalability. Once a system is in place, it can be repeated across multiple properties. Instead of reinventing the wheel each time, you follow a proven process that delivers reliable results. This efficiency allows you to grow without chaos. It also makes it easier to delegate responsibilities to your team because they're following established procedures rather than improvising. Technology plays a role here as well. Modern property management software can track income and expenses, automate rent collection, and provide real-time data on portfolio performance. Communication tools keep you connected with your team, while financial software simplifies reporting and tax preparation. By embracing technology, investors can operate with greater precision and less effort, freeing up time for strategic decisions. At the heart of building teams and systems is the recognition that your most valuable resource is not money, it is time. You can always make more money, but you cannot create more hours in a day. By leveraging the expertise of others and relying on efficient systems, you reclaim your time. That time can then be used to find new opportunities, expand your network, or simply enjoy the freedom that investing is meant to provide. McElroy shares that many investors resist this transition. They are reluctant to spend money on professionals or fear giving up control. Yet this short-term thinking often keeps them stuck managing a handful of properties rather than building true wealth. By refusing to delegate, they limit themselves. By clinging to control, they exhaust themselves. It is only when they embrace the team mindset that they break through to the next level. Ultimately, the message is clear. If you want to be more than a landlord, if you want to become a true investor, you must build a team and establish systems. Alone, you can buy a property or two. With a team, you can build a portfolio. Alone, you are limited by your energy and knowledge. With systems, you multiply your efficiency and minimize errors. This is not about ego or proving you can do everything. It is about building a business that works, a business that grows, and a business that eventually runs with or without you. Real estate, when approached this way, becomes not just an investment, but an enterprise. And it is through this enterprise, supported by strong people and solid systems, that lasting wealth is created.
Part 6. Growing Wealth Through Real Estate. By the time an investor has learned how to find deals, secure financing, and build a team, the path to wealth is no longer theoretical, it is practical. Yet the journey does not stop at buying a property or two. The real power of real estate investing lies in growth, in creating long-term wealth that compounds year after year. Ken McElroy reminds us that this stage is where ordinary investors often stall, while those who embrace the mindset of scaling continue building until financial independence is fully secured. The first principle of growing wealth is patience. Real estate is not a get-rich-quick scheme, it is a long-term wealth-building machine. Properties produce steady cash flow month after month, and over time, they appreciate. Mortgages are gradually paid down, increasing equity. Tax advantages compound the benefits further. Alone, these effects may seem slow, but over decades, they add up to substantial wealth. Investors who understand this are not chasing overnight success, they are building a foundation that will stand the test of time. Growth, however, is not passive. It requires deliberate strategy. One way investors accelerate their progress is by reinvesting profits rather than consuming them. Instead of spending cash flow on luxuries, they use it to acquire more properties. Each new investment produces more income, which is then reinvested again, creating a cycle of compounding growth. This is how portfolios expand from one property to 10, from 10 to 50, until the income is more than enough to replace traditional employment. Scaling also requires moving beyond single-family homes into larger assets. McElroy highlights the advantages of multifamily properties, such as apartment buildings. With multifamily investments, multiple units generate income under one roof, spreading risk across tenants and increasing efficiency. One vacancy has little effect when 9 other tenants are paying rent.
Management is centralized, maintenance costs per unit are often lower, and financing larger properties can sometimes be easier because lenders see them as stable income-producing assets. For investors serious about building wealth, multifamily is often the natural next step. Another element of growth is continually improving properties. Real estate is not static, it can be enhanced. Strategic renovations, energy-efficient upgrades, or better management practices can all increase a property's value and income. For example, adding amenities, improving curb appeal, or updating units can justify higher rents and attract better tenants. By raising net operating income, you also raise the property's market value, since income-producing real estate is valued based on its cash flow. This allows investors to refinance, pull out equity, and use it to purchase additional properties, further accelerating growth. Yet with growth comes new challenges. Larger portfolios require more oversight, more systems, and stronger leadership. This is where the discipline of building a team and establishing processes pays off. Investors who try to manage expansion alone quickly burn out. Those who rely on trusted managers, contractors, accountants, and advisors can scale smoothly. McElroy emphasizes that at this stage, the investor's role is less about fixing toilets or chasing tenants, and more about vision and strategy, deciding where to invest, how to allocate resources, and when to take calculated risks. Mindset also plays a critical role in growth. Many investors limit themselves because they cannot imagine operating at a higher level. They are comfortable with a few properties and hesitate to take the next step. McElroy encourages breaking through this mental barrier by thinking like a business owner rather than a landlord. The question is not, can I manage another property, but how can I build a system that manages 20 properties? This shift in perspective is essential for anyone seeking true wealth. Of course, mistakes are inevitable. Every investor will face setbacks, whether from unexpected repairs, difficult tenants, or shifts in the economy. But McElroy stresses that mistakes are not failures, they are lessons. The key is to learn quickly, adapt, and keep moving forward. Avoiding mistakes altogether is impossible, but being paralyzed by fear of them is the surest way to stagnate. Growth belongs to those willing to act, adjust, and persist. Long-term success also depends on protecting what you build. Insurance, legal structures, and proper financial planning are not glamorous, but they safeguard wealth. Many investors create limited liability companies or other entities to hold properties, separating personal assets from investment risks. Comprehensive insurance policies cover liability, property damage, and loss of income. These measures ensure that one setback does not erase years of progress. Another wealth-building principle is diversification. While real estate itself is a strong asset class, within it there are many niches: single-family rentals, multifamily, commercial properties, storage units, and more. Diversifying across different property types or geographic areas reduces risk and provides stability. If one sector slows, another may thrive. This balance helps sustain growth through changing market cycles. Perhaps the most profound lesson McElroy offers is that wealth through real estate is not only financial, it is also about freedom. The goal is not simply to own buildings, but to create a life where money is no longer the central worry. When passive income covers expenses, choices expand. You can pursue passions, spend more time with family, or focus on projects that matter most. Real estate becomes the vehicle for a life of independence and purpose. Finally, McElroy reminds us that wealth is a journey, not a destination. There is always another level to reach, another opportunity to explore. The true reward is not just the money earned, but the knowledge gained and the growth experienced along the way. Each property teaches you something, every deal strengthens your skills, and every challenge builds resilience. Over time, these lessons compound just like the financial returns, shaping not only your portfolio, but your character as an investor. In the end, growing wealth through real estate is a matter of combining vision, patience, and action. It's about reinvesting, scaling, improving, protecting, and never stopping the pursuit of growth. With these principles, an ordinary individual can build extraordinary wealth, not overnight, but steadily, surely, and with lasting impact. McElroy's message is clear. The system works if you are willing to work the system.
Conclusion: the lasting wealth of real estate. Real estate investing, as Ken McElroy shows us, is not a mystery reserved for the wealthy or the well-connected. It is a clear and repeatable process, one that anyone can master if they are willing to learn, prepare, and take deliberate action. From understanding the fundamentals of cash flow, to finding the right properties, to building strong teams and scaling portfolios, the path to financial independence is laid out step by step. The central lesson is simple yet profound. Wealth in real estate is not built by luck. It is built by knowledge, by discipline, and by the courage to move forward even when the path feels uncertain. Every investor starts at the same place, with a single property, a single decision, a single step. What separates those who stop from those who build lasting wealth is the willingness to stay consistent, to learn from mistakes, and to think bigger with each opportunity. McElroy makes it clear that real estate is a long game. Cash flow is the heartbeat of wealth, appreciation is the silent partner, and tax advantages are the hidden accelerator. Combined, they create a powerful engine that grows steadily over time. For the patient investor who reinvests earnings, scales wisely, and manages risk, the rewards are life-changing. But the true reward is not just the money. It is freedom. When passive income replaces the need for active labor, when rent checks cover expenses, when time itself is reclaimed, the meaning of wealth becomes something deeper. It is the ability to live with purpose, to make choices based on values rather than necessity, to build a legacy that extends beyond personal gain. The journey is not without obstacles. Markets shift, tenants move out, financing tightens, and unexpected repairs arrive without warning. Yet each obstacle is also a teacher, each challenge a stepping stone. The investor who keeps going, who treats every difficulty as an education, emerges stronger and wiser. In real estate, persistence is often more valuable than brilliance, and steady action outperforms grand intentions. As the book closes, the message echoes: do not wait. Start where you are. Learn what you can. Surround yourself with capable people. Take the first step, even if it feels small. Because each property leads to the next, and each decision compounds into a future you could scarcely imagine at the beginning. Real estate investing is more than numbers on a spreadsheet. It is about building a foundation for freedom, for security, and for possibility. It is about creating wealth not only for yourself, but for future generations. And most of all, it is about proving that with vision, patience, and consistent action, anyone can transform their financial destiny. The ABCs of real estate investing are not just lessons. They are an invitation to think bigger, act boldly, and step into the world of lasting wealth. The choice rests with you. Will you watch from the sidelines, or will you enter the field and begin building the life you've always imagined? And there you have it, The ABCs of Real Estate Investing by Ken McElroy, distilled into practical wisdom you can start applying today. Remember, financial freedom doesn't come from wishing or waiting. It comes from learning, taking action, and staying consistent. Every great investor you admire started with a single step. Now it's your turn. If this summary has inspired you, don't let it end here. Revisit the lessons, take notes, and most importantly, start acting on them. The millionaire path in real estate is not reserved for a lucky few. It's available to anyone willing to think big and move wisely. If you enjoyed this video, make sure to like, subscribe, and hit the notification bell so you never miss future summaries packed with wealth-building insights. And in the comments below, share what step you're taking today toward your financial freedom. I'd love to hear your journey.